Assalamu alaikum and good afternoon. This is our second session on financial instrument, and we will continue from where we ended yesterday. Yesterday we started discussion of International Financial Reporting Standard 9 and International Financial Reporting Standard 9 should I start again? Assalamu alaikum, good afternoon. We will continue with financial instrument, and yesterday we started IFRS 9 and we started discussion of financial liability, how to treat financial liability, and we learned yesterday that financial liability will be treated either at amortized cost subsequently or fair value through profit or loss. Fair value through profit or loss. So yesterday we learned how to account for an amortized cost. When you initially measure your financial liability at fair value less issue cost, and that liability when it has to be measured subsequently at amortized cost. So we discussed this area yesterday. Now we shall be discussing the fair value. If you will be recognizing your financial instrument subsequently at fair value, then what will be the accounting treatment? So we shall learn that accounting treatment with the help of this illustration. See, this illustration is in front of you people. On 1st January 2011, A Limited issued 3-year 5% $30,000 loan notes at a nominal value, when the effective rate of interest is also 5%. The loan notes will be redeemed at par. The liability is classified at fair value through profit and loss. At the end of the first accounting period, the market interest rate have risen to 6%. Required. Explain and illustrate how the loan is accounted for in the financial statements of A Limited in the year ended 31st December 2011. See, so far as the initial recognition is concerned, we learned that this will be initially recognized at the fair value. In this case, the consideration received. So what is the consideration received? 30,000. Is there any discount? No, there is no discount. So this asset will be initially recognized at 30,000. This asset will be initially recognized, this financial liability. So your entry will be debit say cash or bank, and credit financial liability account. So this is the initial recognition. There is no discount, there is no premium, and there is no issue cost as well. Had it been there, issue cost would not have been deducted from this 30,000, because we learned in our earlier slides that where a financial liability will be kept subsequently at fair value through profit and loss account on its initial measurement, fair value will not be reduced by the issue cost. But anyway, in this question, there is no issue cost. Had it been there, we would have ignored for the purpose of initial recognition. That is simply an expense. That is simply an expense. Okay. So subsequently, for example, here it is mentioned what will happen at the end of first year. Okay, let's use an empty slide. So this illustration should be in front of you. See, we shall be using the same format. Year, for example, this is year 1, 2011. And the opening liability, as we recognized, opening liability is 30,000. Opening liability is 30,000. And then finance charge, that will be calculated at the effective interest rate prevailing during the year, which is 5%. So this will give us the profit and loss account charge. And this will become, if we multiply 30,000 with 5%, this will give us 1,500. Now, cash paid. Cash paid. Of course, cash is paid, that is equal to the interest paid. So yesterday we learned, in order to calculate the interest paid, we will multiply the coupon rate of interest. In this case, coupon rate of interest is also 5% with the face value of the loan. And here in this case, it is 30,000. So this will give us again 1,500. So liability will become, for example, if this is A, this is B, this is C. So A plus B minus C. This will be the formula. Here by chance both figures are same, but in yesterday illustrations you might have noted that in some illustrations these were different figures. So here it will appear 30,000. Now at the end of 2011, at the end of, this figure we reached on 31st December 2011. But at this date, there are changes in the interest rate. See, go back to your illustration. The last line, it says, at the end of the first accounting period, market interest rates have risen to 6%. At the end of the first accounting period, market interest rates have risen to 6%. This means we will continue our calculation as we did yesterday, as we did in case of amortized cost. But at the point where market rates are being changed, market interest rate of the similar debt are changing, at that point we will recalculate the fair value of this instrument. So whatever is the fair value, any difference between this value and the calculated fair value, the difference will be sent to the profit and loss account. See, the interest rate is increased to 6%. Interest rate is increased to 6%. So in order to calculate the fair value, see, the formula is very simple. This means what we are going to do, we are going to calculate fair value of this financial liability, I think, which is bound. Financial liability at 31st December 2011. Simply enlist the future cash flows related to this liability. For example, at the end of 2012, what is the life of this liability? The life of this liability is, it was issued on 1st January 2011, and this will be redeemed at par. When will this be redeemed? Okay, here we can assume that the life of this asset is 3 years. So this will be redeemed at the end of 2013. So from this date, this is year 1, this is year 1, this is year 2, because we are going to calculate fair value of this financial liability at this date, and with reference to this date, this will be first year and this will be the second year. What are the cash flows attached? Cash flows attached with this financial liability are, at the end of 2012, you will be paying 1,500 interest payment, and at the end of 2013, you will be paying 1,500 plus redemption at par. This means 31,500 will be the cash outflow at the end of 2013. Discount rate. Discount rate will be used, the new market rate, which is now 6%. As we learned that 2012 is first year, and for first year the discount factor will be 1 divided by 1.06 raised to power 1. So this will be multiplied with 1,500. This will be multiplied with 1,500 in order to reach the present value for the first year, and the sum of these two will be multiplied with the second year discount factor. So this will give us the present value 1415 and 828,035. So this will give us the total. So total will be 29450. 29450. What is this? This is basically, sorry, I think, what was the amount over here? This was 1415 and this was 28035, and the total was 29450. So this is basically fair value of this financial liability at 31st December 2011. Whereas the balance before making any fair value adjustment is 30,000. So liability is reducing. So our closing liability, which will appear in the statement of financial position, will be 29450. 29450. The difference between these two will be charged to the profit and loss. The difference between these two will be charged to the profit and loss, and that amount is in fact 550. This will go to the statement of financial position, and this is in fact the gain or loss. This is in fact the difference between these two values. The same way you will continue, like though it is not required, but in 2012, this is the opening balance. This is the opening balance, and you will be applying 6% on this, because now the effective interest rate for this year is 6%. So, but this will remain unchanged because it is not, your coupon rate of interest is independent of the market rate of interest, whereas now for 2012 the effective interest rate for the calculation of finance charge, which will be charged to the profit and loss account, will be calculated at the rate of 6%. So if you just calculate what is the 6% of 29450, so this will give you 1767. This is for second year. Again, when we apply this formula, so this will give us 29717. Let me check this. 29450 plus B 1767 minus 1500. 29717. Because question is silent about the market interest rate at the end of 2012, so the same will be the financial liability, because there is no change in the market interest rate. If there is a change at the end of 2012 in the market interest rate, after these calculations, again you will be calculating the same way the fair value at the end of 2012. And the difference between the fair value you calculated by applying this technique and this 29717 will go to the profit and loss account. So in first year, our double entry will be like, for initial recognition, we pass the double entry whereby we debited the cash or bank with 30,000, the amount received, and credited the financial liability. And subsequently, at the end of year 1, first entry will be related to this. See, we have paid the cash, credit, cash, credit cash, that is the interest paid. We are making entries at the end of 2011. And debit finance charge in the profit and loss account, which is 1500. So because both are same, so there is no balancing figure. Had it been any balancing figure, that would have gone to the financial liability. And another entry will be related to this. For this, see, our liability is decreasing. Instead of 30,000, when we recalculated its fair value at the end of 2011, the liability has become 29,450. So liability is reducing. So the entry will be debit financial liability with 550 and credit profit and loss account 550. So this will be the entry related to the gain or loss at the end of 2011. This is in fact the difference between the carrying value as calculated using the information available during 2011 and the fair value. So this is the way you will account for financial liability which will be carried at fair value. Whenever there is a change in the market interest rate, at that point in time, you will be recalculating the fair value of that instrument. The method is simply look at what are, from that point in time, what are the remaining cash outflows related to that financial liability, and discount those cash outflows using the new market interest rate. This will give you the present values, and when you add up these present values, this will give you the fair value of your financial liability at that date, and then calculate the difference between the carrying value of that liability, which is in this case 30,000, and the fair value you calculated using the new market interest rate. This difference will be sent to the profit and loss account. Why I use the word sent? Because it could be a gain or it could be a loss, because your fair value can be higher than your carrying amount of the financial liability immediately before this adjustment, or your fair value could be lower than the carrying amount of the liability. In both cases, the difference will be sent to the profit and loss account. So this was the illustration. So please note this solution. When I will go for the question answer break, then you can ask if you have any question related to this. No. The next is, for next I have to raise all this stuff. Now, about de-recognition of financial liabilities. About de-recognition of financial liabilities. A financial liability is de-recognized. A financial liability is de-recognized when it is extinguished, that is when the obligation specified in the contract is discharged or cancelled or expires. There are various situations given in this slide. I will be illustrating one of the situation with the help of an illustration. Number one, where an existing borrower and lender of debt instrument exchange on financial instrument for another with substantially different terms, this is accounted for as an extinguishment of the original financial liability and the recognition of a new financial liability. In this case, when you enter into a financial instrument with substantially different terms, there the first financial liability will be derecognized. Similarly, a substantial modification of the terms of an existing financial liability. If there is a substantial modification, then or a part of it should be accounted for as an extinguishment of the original financial liability and the recognition of a new financial liability. Third one, which we will understand with the help of an illustration as well. For this purpose, a modification is substantial where the discounted present value of the cash flows under the new terms, discounted using the original effective interest rate, is at least 10% different from the discounted present value of the cash flows of the original financial liability. The difference between the carrying amount of the financial liability or a part of the financial liability extinguished or transferred to another party and the consideration paid, including any non-cash asset transferred or liabilities assumed, shall be recognized in profit and loss. So what we learned from this slide, number one, two things we learned mainly. Number one, when you will be derecognizing a financial liability, when you exchange your existing financial liability with another financial instrument with substantially different terms. So the first financial liability will be derecognized. Or if you modify the terms of your existing financial liability, if you modify the terms of your existing financial liability, and that modification should be substantial, then you will be derecognizing your original financial liability and will be treating it as a new financial liability. What is a substantial? That is defined in 3. And what is the difference between the new financial liability recognized and the derecognition of the old liability? That will be charged to the profit and loss. So let's see. Okay, this is an example for you people. I hope it should be with you, but anyway, it is in front of you. If it is not with you, I'll be sending it to you. So the example is, during the year ended 31st December 2008, a Pakistani sugar company, PSC, was facing severe problems in meeting its obligations. In October 2008, Pakistani sugar company commenced negotiations with the lender for restructuring of loan. Okay. Following is a summary of the liabilities of the company as of 31st December 2008, prior to making adjustment on restructuring. Okay, I think this is the whole question. Okay, this is the whole question. I should reduce this font so that we could see the whole question. Whole question should be in front of us. Okay. This is the whole question. So on December 31st, 2008, this is the loan amount. And this is the revised value of the loan amount. This is the revised value of the loan amount. But bases are different. The revised value of the loan amount 29.60. And revised present value as per original effective interest rate 31, revised present value as per the market interest rate of similar instruments, that is 32 million. See, this was the loan, this was the loan, and which one is the relevant amount? So this was the original loan, and this is revised present value as per original effective interest rate. If we go back to our slide, we can see that in slide okay, I think I'll have to first go to the normal mode, then I can open my slide. Okay, this was the slide. Yes, it was the slide. See here, when the modification will be substantial, when discounted present value of the cash flows. And what is the discounted present value of the cash flows? That is 31,200,000. 31,200,000. This is the discounted value of the cash flow under the new terms. Under the new term, please excuse me because of continuous session. I'm having a cough problem. So this was the value under new terms, and the value under the original terms was, as we saw, 28 million. What you did, you simply applied the original effective interest rate. Applied the original effective interest rate on the revised term. So this give you 31.2 million, whereas this is your original liability. So the difference between these two figures is approximately, the difference between these two figures is 31.2 minus 28. This will give, the difference is 3.2. The difference is 3.2. When you divide it with the original liability into 100%, this will give you 11.43%. So this is an example of substantial modification. Okay, if we come back to our question, see in our question, this was the loan amount with the original effective interest rate at December 31st, 2008, and this was the revised present value as per original effective interest rate. This is important because this 32 million was revised present value but as per market interest rate. So this is not relevant. Again, revised value of loan account is not relevant. So this will be the relevant figure, which is present value as per the original effective interest rate. So this is the present value original effective interest rate. This is the loan value without taking into account the change in the terms. The difference between these two figures, is 11.43%. So this means you will treat this liability as if it is de-recognized. So de-recognize the old liability and recognize the new liability of 31.2 million. What will be the double entry? Please note, the double entry is because you are de-recognizing the liability. So your old liability, loan from SBD, this is the old loan, will be debited with its carrying amount, which is 28 million, and credit the new liability. Again, this is loan from SBD, but this is a new loan. This will be treated as a new loan, and that will be credited with 32 million. The balancing figure, balance will appear here. The balancing figure will be debited to the profit and loss account, which is approximately 4 million, which is approximately 4 million. So this way you will be treating de-recognition. Now I do expect one question will arise. While deciding whether this change in terms is substantial or not, we compared this original liability with this figure, which is the revised present value as per the original effective interest. But when we recognized the new loan, we applied 32 million because this new loan is being initially recognized. So on initial recognition, we shall use the fair value of this loan, and the fair value will be calculated by using the market interest rate prevailing at the date of this change. So that's why we used 32 million instead of 31.2 million. The difference between these two will be sent to the profit and loss account. So we have completed 2 comprehensive questions. Now I can expect that you might have some queries, or you may need certain explanations. So please feel free to ask so that we could move to another aspect. So by this way, this will end substantially our discussion on the treatment of financial liability. I am using the word substantially. This means I will be discussing few more aspects related to the financial liabilities later on. But this was the substantial aspect so far as the treatment of the financial liability under IFRS 9 is concerned. Yes, please.
Okay, first question is from Krishna.
Yes,
and Krishna is saying if the coupon interest rate is a mixture of both 2.5% fixed plus 3-month EIBRO, then shall we need to reassess the future value of it in each year? Annually?
If the coupon rate of interest is changing, if the coupon interest rate is changing, of course, then it will have to. Yes, Krishna. If it is on the variable rate, so that will be automatically adjusted. I hope it should be clear. And our next question is from Mr. Harun, can you please
Qasim Ali, can you please
Qasim.
elaborate the effect of unwinding of discount effect on total liability each year?
Unwinding of
Discount effect on total liability each year.
Qasim, I have not mentioned anything about the unwinding. In fact, in our okay, let me convert it to the normal mode. See, in my first illustration, in this illustration, this was the liability, and as a result of passage of time, finance charge was being created. So if you are naming it as a unbinding, okay, fine, but this was the finance charge. So what you specifically wants me to tell you? Qasim, please tell me specifically.
All right, the next question is...
Qasim, please, can you be specific in your question?
Yeah, we'll see if Qasim asks the question again. Shayan Ahmed Qureshi is saying today's handouts. The handouts have been uploaded, and I will email them to all of you in a bit as well. But however, if you're using a laptop or a computer, you should be able to download the handouts from GoToWebinars.
Yes.
Fateh Mohammed is asking, would you please clarify the rationale behind not considering the revised value of loan amount?
Not considering the
revised value of the loan amount.
Mr. Fateh, I suppose your question is related to the de-recognition of financial liability and the recognition when there is a substantial changes in the terms of financial liability and recognizing it as a new loan. Okay, if it is, then as we learned yesterday that financial liabilities will be initially measured at fair value. So you can only calculate fair value by applying the market rate of interest prevailing at the date when you measure the fair value. So that's why we used 32 million for the recognition of the new loan. Fateh, I hope it should be clear.
Kaisar Majid has the same question. I'm sure you want to know.
Kaisar, I answered this question. Please, if you need to.
Why we credited 32 million instead of 31.2?
If it is not clear, I just answered this question. If you still need some explanation specifically, then I can discuss that.
Kaisar is saying please explain with the rule reference.
With the rule reference, okay. Kaisar, okay, let me go to that. This is the slide. There are two things within this slide. One is when you can de-recognize a financial liability. Okay? And that is when there is a substantial modification of the terms. So I hope you are clear about this. This was our financial liability before de-recognition, and this was 31.2 million was calculated, and which is discounted present value. 31.2 is discounted present value of cash flows under the new terms. I hope it is clear. Okay, this is 31. Now, first decision is, should we de-recognize this 28 million? This is the first decision. This will not affect the second decision. There are two things which need to be decided. Number one, should we de-recognize the existing liability? This is the first question. That will be answered according to this slide. And so far as the second question is concerned, like the amount at which new liability will be recognized, amount at which new liability will be recognized, that this slide does not address this question. So okay, we answered first question, that should we recognize this 28 million? The answer was yes, because when we saw the difference between these two, this was more than 10% threshold. So that's why we made first decision, Fatih, on the basis of guidelines given in this slide. Okay. Now, what about the new liability? At what amount it should be recognized? So about this, we will have to go back to an earlier slide. Okay, let me bring it to the normal mode. An earlier slide is, that is, I suppose, this was our earlier slide, that financial liability initially measured at fair value. Financial liability will be initially measured at fair value in both cases. So what is the fair value? Fair value is 32 million. I hope Fatih and the other respected member, I hope it should be clear.
Okay, Deepak Tekmani is asking, can we say that amortized cost and FVTPL has the same impact on profit loss as SOFP?
Statement of financial position. Deepak, can you specify your question, because this is a very general statement. I cannot say yes or no on this.
And now someone is saying, sir, how the revised present value as per original effective interest rate is changed when comparing to the loan amount? Is it because of changing in repayment schedule or otherwise?
Yes, there are certain terms and conditions which are not given in the question. So those were the reasons, maybe interest payments or maybe redemption values or whatever. These would be the reasons. So because of these reasons, so they change the terms. So the change terms are not given, but values are given. Okay, on the basis of those revised terms, this will be the value. But we know how to calculate it. We just discussed before this illustration. Within this illustration, we calculated how to calculate the fair value of a financial liability at a given point in time. Simply see what are the future cash flows of that financial liability and apply the market interest rate at the date when you want to calculate the fair value. So this will give you the fair value of that liability. Similarly, they would have calculated that 32. But anyway, we are not given the detail how they have calculated 32 million.
Shayan Ahmed Qureshi is saying PPR 550 shall go to the statement of comprehensive income or statement of profit and loss.
This will go to the profit and loss. This will go to the profit.
That's all.
Okay. So this was okay. Now we shall be revisiting International Accounting Standard 32. International Accounting Standard 32. So don't consider it the end of the session, though I think you can be said anywhere in between our discussion. So the next is now. Okay, let's revisit in order to understand certain aspect in International Accounting Standard 32. Issue cost. Yesterday we had a discussion on IC 32 and we discussed compound instruments as well. Basic concept will remain the same. Now, normally when there is an issue cost, when practically there is an issue cost, while issuing a compound instrument or convertible debentures. So how to handle it while bifurcating will remain same, but we need to understand the effect of issue cost. See, if an entity issues a financial instrument that is a hybrid instrument, for example, convertible debentures, then the holder of such instrument has the option either to convert it into the fixed number of equity shares or cash at the date of redemption. ISO 32 requires the hybrid instrument should be recorded by separating the debt and equity element. We learned yesterday these steps, step number 1, step number 2 for the calculation of the debt portion, and we learned that equity portion is the balancing figure. Okay. Now let's come to this this example. On 1st July 2011, 2 million convertible debentures of rupees 100 each were issued. Each debenture is convertible into 25 ordinary shares of rupees 10 each, and on 30th June 2014. Interest is payable annually in arrears at the rate of 8% per annum. On the date of issue, market interest rate for similar debt without conversion option was 11% per annum. However, on account of expenditure of 4 million incurred on issuance of shares, the effective, it should be on debentures. It should not be shares, it should be debentures. Please make it debentures. Okay, let me make it so that you can make accordingly the change in it. On the issuance of convertible debentures. Convertible debentures. Convertible debentures. So correct your copy because you received in PDF form, so you can correct it with the help of pen if you have already taken the print for these slides. So issuance of convertible debenture. This was the issue cost. The effective interest rate increased to, because of this issue cost, 11.81%. Prepare journal entries for the year ended 30th June to record the above transaction. But our focus is to understand it with the help of, like, with reference to the initial recognition. Okay. So far as the initial recognition is concerned, see, 2 million convertible debentures. How much cash we received? We received 2 million in 200. Mean 200 million cash was received. Each debenture is convertible into. Now we need to bifurcate this 200 million into debt and equity. So remember, for this purpose, only use this 11%, and without the effect of, forget for this purpose the effect of any issue cost. We shall be incorporating the effect of the issue cost, but for the purpose of bifurcating, forget about the issue cost, and of course the effective interest rate which will be used is the one which is without the effect of the issue cost, is being 11%. So okay, try to calculate with the 11%, and the life of this instrument is 12, 13, 14. So just assume that from however till this point, I mean last sentence is not present in this question, and simply try to calculate the debt and the equity portion as we learned yesterday. So I'll give you one minute for this.
Question, I guess, and you should ask the question now.
One question. Just after 1 minute, we can continue with that question.
Send out handouts.
This question just for the reference purpose. Okay, we can take the question of Mr. Qasim. Mr. Qasim is a Qasim. Yes, Mr. Qasim, please.
Sorry, Kasimajit. Saying, will the difference of rupees 4 million be amortized?
The difference of
Rupees 4 million.
no, he's asking a question about this illustration. I have not yet explained it. Mr. Qasim, can you please?
Yes, sir, Mr. Qasim.
Mr. Qasim, can you? Sorry for wrongly naming you. Can you please forget about this 4 million and just quickly bifurcate that 200 million which we received in cash, assuming we have received this much amount between liability and equity as per the method we discussed yesterday. Okay. So this should be because it is basically, I can use pen from here because this is these slides are with you, so I can use some Word document here. I can use some Word document here, new Word document. Okay. See, yesterday we learned the step number 1 was, okay, maybe I can have pen from here, but unfortunately not. Okay. So what are the future cash flows? We learned yesterday that first of all we will see what are the future cash flows, and the life of this compound instrument is 3 years. 1, 2, 3 mean 2012, 2013, and on 30th June 2014 this will be redeemed. And what are the cash flows during these years? One is the interest payment at the rate of 8%. So we shall calculate on 200 million at the rate of 8%. This will give us 16. So this is in million. Similarly, in year 2, this will be 16 million. In year 3, this will be 16 million plus 200. So this will give us 216. And the discount factor applicable for this purpose, as I said earlier, ignore the effect of issue cost for the calculation. So this will give us the discount factor at the rate of 11%. For first year, this will be 1 divided by 1.1111, and in the second year 1 divided by 1.11 raised to power 2, and in the third year the discount factor will be 1 divided by 1.11 raised to power 3. So this will give us the present values 14.41, and this is 12.99, and this is I suppose 11.7 plus 1, 46.24. So this will give us 157 0.94. So the total will be 185.34. So this is the debt element. This is the debt element. And what is the equity element? We all know from yesterday's discussion, that is the balancing figure. 200 was the total, and when we deducted 200, so this will give us 14.66. So this is the equity element. So this is the breakup of this 200. So this will remain the same. Now, next we will take into account the issue cost. I hope my figure should not disappear anyway. Okay, let's come down. I hope you might have noted these figures. Okay. Now what you will do, for the purpose of entry, you can make separate entry. Or you can compound it also, unfortunately. Anyway, you people might have seen our calculation. I can write here for you. Please, as I said earlier, your pen and your notebook should be ready. If these are ready, so please, you might have noted, and so please note it. We just calculated debt element as 185.34 and equity element as 14.66. Okay, so this was our first step. Next, allocation of issue cost. So you can take it as a third step, because two steps are the same. We ignored the issue cost in the calculation, in the bifurcation of debt element and the equity element. Now we shall be allocating the issue cost like this. Debt element, and then equity element. Debt element proceeds related to this 185.34 using step number 1 and step number 2. 14.66, the total is 200, and then issue cost. 4 million was the issue cost. So we shall be allocating this 4 million on a pro rata basis. For example, for this debt element, the factor will be, but I am afraid my figures will disappear. Okay, I mentioned here small star. So this small star means not a very beautiful star. Anyway, it looks like star. Very far away star, in fact. Because we have our respected member, hopefully today from Morocco as well. If that member is attending this session, so please tell us. So that's why star is far away from. So from far away, the star will be look like this. Anyway, so the factor will be 185.34 divided by 200 into this issue cost. So this will give us 3.71. This will give us 3.71. So this amount will be allocated to the debt element. And likewise, if I mention here 2 asterisk instead of star, because my star is, I cannot draw a good star, so 2 asterisks. So here, the same way, pro rata basis, 14.66 divided by divided by 200 into 4. So this will give us 0.29. So this way you will allocate the issue cost to each element. This way you will allocate the issue cost to each element. So this will give us 196. Let me check this calculation. 185.34 divided by 200 into 4. Okay, fine, this is correct. Okay. So if you people are clear on this, only then I will move to the journal entry. First of all, be clear about this allocation. So if you have any question about this allocation, please feel free to ask. Okay, should I move further? If you do not have any question.
There are questions.
Okay, please.
Okay, Kaisar Majid is asking for solutions. Kaisar, I'm about to email yesterday's solutions to you. Muhammad Jan is saying the benefit of the session is that the question is in my mind is asked by someone else, and also the question which I didn't consider is also asked by someone else. Good learning webinar. That's thank you to ACC, and that's why I'm not asking any questions.
Okay.
Now I need to ask questions. So. Okay, Kaisar Majid is saying any short breaks in session. I think we'll take a break in about 25 minutes.
25 minutes.
Zishan Hafiz also desperately needs a break. Zishan, wait for 45 minutes. Imran Samad is saying sir, I'm in Melbourne. So you can have stars like this.
Oh,
so Melbourne is
yes.
even further away.
Welcome. You're welcome.
Shayan Ahmed Qureshi saying, please re-elaborate once again. Shayan, what exactly do you want to be elaborated? You can mention it.
Shayan, see, the question is in front of you, I hope. See, if I quickly just read through this question. The question is, like you have issued a convertible debenture. I'm not moving from this screen because otherwise this will disappear. This write-up will in fact disappear. Convertible debentures, and you collected 200 million. And out of 200 million, you paid 4 million as an issue cost. So the first step is how to bifurcate this 196 million between debt and equity element. So the first step is forget about this issue cost.
So Shayan he's saying specific
Okay.
question. He's saying classification of issue cost is already clear to him.
Okay, fine.
Classification of debt and equity is what he wanted to know.
Okay, Zishan, okay, I'll have to move to another page. So if anybody has any question related to the calculations on your screen, please ask now, because in order to answer the question of Mr. Zishan, I have to move to another screen, and
It should be alright, it doesn't go away. I don't think it
no, this way. Okay.
Let's try. No, but can you not move on to the second page in the same document?
No, I cannot. This is the problem. See,
Alright.
this is the problem. So I have already experimented it yesterday. So we can try some other way. No, it will not work. So okay.
When you can revert back to
Yes.
normal mode.
No. When I go to the when I move here, this will disappear.
Oh.
So this is the
I'll
first.
try to install the software in the meantime.
Okay. Yes. Okay, Mr. Zishan. See, we learned yesterday 2 steps. I'll show you again here. Slideshow.
There are 3 questions.
Okay. No problem.
Musa was saying, can you explain the calculation of issue cost?
Okay.
Kumar is saying you can take a screenshot. He's right. You can take a screenshot.
Yes. You're right.
Thank you, Amis.
Thank you. Anyway, Zishan, this is the first step. Determine the future cash flow attached to the compound instrument. So our compound instrument is our compound instrument is okay. Our compound instrument is like we have collected 200 million minus 4 million issue cost. This is the issue cost. Step number 1 and step number 2, nothing to do with the issue cost. What step number 1 says? Determine the future cash flows attached to the compound instrument. What are the future cash flows? We just learned these were the interest payments. These were the interest payments over the life of this instrument, and life of this instrument is 3 years. Like first year, second year, third year. To make it simple, cash outflow in first year is 16 million, in second year it is 16 million, in third year it is 16 million plus 200 redemption payment. So these are the outflows attached to this compound instrument. So this is step number 1. Zishan, please say yes if you are clear about step number 1. So these are the cash flows attached. Zishan, say. Sorry. Shayan, sorry. Sorry, Shayan. Shayan, are you clear?
Yes.
Okay. Okay. Now step number 2. Discount future cash flows using the market interest rate. Market interest rate is given, that is 11%. So we will discount. So for first year, the discount factor will be 1 divided by 1.11. You can see the table as well for 11% discount factors. For second year, this will be the discount factor, and for third year, this will be the discount factor. And the present value for these will be, as I calculated, for this 14.41, and this is 12.99, and this will give me for 16 million 11.7, and for 200 this will give me 146.24. You can add these two figures, no problem. You can apply this factor to the addition of this, then automatically when I total, so this will give me the 185.34. So this is the debt element. Out of 200. For step number 1, for step number 2, please ignore issue cost. Straight away assume there is no issue cost. Apply step number 1, apply step number 2. This will give you the debt element. The difference between this 200 and this debt element will be your equity element. Equity element, which comes to 14.66. Shayan, I hope it should be clear. Shayan, is it clear?
Yes.
Okay.
Shayan is saying thank you.
Do we have any other question? Because
just give me a minute. I think it's good. Hello.
okay. So next, what we did, we allocated the issue cost to the debt element and the equity element. I hope you people will be having with you that calculation. That if I very quickly write here, for debt element, for equity element. For debt element, for equity element, this was 1.185.34 we just calculated, and this was 14.66, and we allocated here 3.71 and here 0.29. So this will give us debt element value after issue cost effect, 14.37. No, No, the journal entry will be, there are two ways to pass the journal entry for this. There are two ways. One is, okay, I can change color for first and then another color for the second. One way is that simply debit cash for bank, debit cash for bank with the amount actually received 196. When you add these two figures, or simply when you reduce 200 by 4 million, this will give you 196. This is the amount which you actually received. Credit debt or financial liability account with 181.63 and credit equity with 14.37. Another method is, instead of going for this compound entry, you can make two separate entries. One, debit cash on the issuance of your convertible, credit financial liability debt account with 185.34, credit equity account, with 14.66, and the second entry for the issue cost, mean debit debt account 3.71, debit equity account 0.29, credit cash or bank with 4 million. Okay, do we have any question or should I move further?
Wait a second. Yes, we have some questions.
Yes.
Okay. There was previously a question from Deepak.
Yes,
You
Deepak.
can answer that. Deepak was saying, this is clear. My other question was, can we say that amortized cost and FVTPL has the same impact in profit and loss in terms of charge to PL and in statement of financial position in terms of balance liability?
Yes, if there is no change in the fair value of that financial liability at the end of that particular year, the effect will be like finance charge and financial liability will be same under both methods. But in case there is a change at the end of that particular year, so the difference will arise, and we learned that difference will go to the profit and loss account. So there will be another figure you will be sending to the profit and loss account related to this instrument.
Okay, Musa Rayami had asked, can you explain again the calculation of issue cost? But since we've moved on, we can ask Musa to have a bit.
No, it is in Musa. It is here. See, what was the issue cost? 4 million. So how I allocated between debt and equity element based on this on a pro rata basis. What was the total amount? Total amount was 200. We collected 200. When you add these two figures, 14.66 and 185.34, this will give you 200. So the relation of 185.34 divided by 200 into 4 million will give you 3.71. And likewise, 14.66 divided by 200 into 4 million will give you 0.29. So this way we have allocated on a pro rata basis. on the basis of the figures which we calculated without taking into account the issue cost. Okay, Nusa, I hope it should be clear.
Kesa Majid is asking, the debenture holder has to get the share only or the debentures will be redeemed at the end of the year 3. I repeat, the debenture holder has to get the share only or the debentures will be redeemed at the end of year 3.
Holder has both options. He can go for both options.
Then he further asks that if debentures can be redeemed in cash, then how it affects the equity portion at the end of year 3.
This will not affect the equity portion. But anyway, if I could have more questions, if those are related to this, then I can answer at some point in time the closing entry for this. Let me move to the next section.
Couple of very quick questions. Fateh Mohammed is asking, should we treat the equity element as other components equity?
Yes.
Okay, Rashid Hanif is saying, please email today's handouts as well. Yes, Rashid, the handouts have already been emailed. Please check your email. Nusa is saying, thank you very much. You understood it. Zishan Hafiz is saying, very nicely explained the last illustration. Thank you very much.
Okay, now we can move to our next presentation.
Shayan Ahmed Qureshi is saying, why are we debiting debt account with issuance cost?
See, Zishan, this was the compound entry, in fact. And if you do not want to do this compound entry, you can do this, because that cost relates to these accounts. Because this will be subsequently measured at amortized cost. So we learned, because this instrument is being initially measured, and on initial measurement, fair value less issue cost. Go back to the earlier slide of initial measurement. So that's why that's it. I hope it should be clear.
Yes, that's it.
No. Okay. No, let's move to the next. Okay. Now, coming back to IFRS 9. Coming back to IFRS 9. Now the financial assets. Now the financial asset. We shall be discussing about the financial assets. Let me open here as well. Okay. Financial assets. See, what are the, so far we have discussed financial liabilities. Now we shall be discussing financial assets. When an entity acquires a financial asset, it will be acquiring a debt asset. For example, entity may be investing in bonds or trade receivables. Trade receivable is a financial asset for the entity who made the sale, or an equity asset. If you buy the shares, if an entity buy the shares of another entity, this will be a financial asset, but this is equity asset in fact. So we have bifurcated financial assets into two categories. One, which are debt assets, and other equity asset. Mean, if you are a company and you invest in the bonds of another company, so this investment is your financial asset, but this financial asset will be termed as debt asset, and this will appear under your asset. But if you buy the shares of another company, this is also your investment, this is also your financial asset, but this financial asset will be termed as equity asset. We bifurcated, we segregated these two types of financial asset because when we shall be discussing accounting treatment, there is a small difference between the accounting treatment of these two types of financial assets. So let's first of all discuss debt assets. See, debt assets on initial recognition, financial assets are classified. Financial asset means debt asset are classified as measured at either amortized cost or fair value through comprehensive income and fair value through profit and loss account. Fair value through profit and loss account. Please be attentive because we are entering into a little bit complex area, but I will try to make it as simple as possible. I have divided my discussion into two areas. One, I'll be explaining the accounting treatment with little technical jargons. Then once accounting treatment, so far as the figure work is concerned, that is clear to you people, then we will be moving towards more qualitative factors. So please hold your question if your questions are not related to the specific material which is being discussed currently. So when we will move to the qualitative aspects, of course, you can ask the question related to that aspect. See, amortized cost, please note here this very important point. This is default position. This is default position. Any debt asset will have to be initially recognized at fair value through profit and loss. But these are conditionals. If certain conditions are there, only then you can measure your debt asset at amortized cost or fair value through other comprehensive income. I repeat, these are conditionals. Mean there are certain conditions which need to be satisfied if you want to measure your debt asset at amortized cost. And similarly, if you want to measure your debt asset at fair value through other comprehensive income, again there are certain conditions which need to be fulfilled before going for this option. But for those debt, otherwise you will be, this is the default position, you can recognize a net asset at fair value through profit and loss. And there is one exception as well. There is one exception as well. And what is that? Even if those conditions are there, even then you can apply number 3. I repeat, if certain conditions are there, you will have to measure. Please note this small sentence. If certain conditions are there, you will have to measure that debt asset at amortized cost. Or if there are other certain conditions, then you will have to measure your debt asset at fair value through other comprehensive income. If none of the conditions required a debt asset to be recognized to be measured at amortized cost or the fair value through profit and loss are not present, then you will be measuring that debt asset at fair value through profit and loss. Okay, so let's discuss those terms very briefly. First is a financial asset that is a debt instrument will be subsequently accounted for using amortized cost if it meets 2 simple tests. These 2 tests are the business model test and the cash flow test. Number 1, the business model test. is met where the purpose is to hold the asset to its contractual cash flows. Very simple. Though we shall be exploring this aspect to some extent, but please underline this. Whatever contractual cash flows attached with that debt asset, what are those? Normally principal and or interest. These are the contractual cash flows. Entity has the intention, and the purpose of the entity is to hold the asset to collect the contractual cash flows. Second, the cash flow test will be met when the contractual terms of the asset give rise on a specified date to cash flow that are solely receipt of either the principal or the interest. Mean those cash flows on a specified dates, either principal or the interest or both, on the specified date. So if these two conditions are fulfilled, then you will measure that instrument subsequently at amortized cost. Because initially fair value and the amortized costs are the same, because initial measurement, whatever you do subsequently, that will be on the fair value, except the difference is of the issue cost. We shall be coming back to this concept again. Next is a financial asset must be classified and measured at fair value through other comprehensive income if it meets both of the following criteria. The financial statement is held with a business model whose objective is achieved by both collecting the contractual cash flows and selling the financial asset. The second is the same as we have seen in the last slide. The contractual terms of the financial asset give rise on specified dates to cash flows, give rise on specified dates to cash flows that are solely payment of principal and interest on principal amount outstanding. So the additional thing is this: selling the financial asset. If your objective, both are the objectives, and second condition is being met, then this must be classified subsequently fair value through the comprehensive income, and all other debt financial asset must be measured at fair value through profit and loss. After the break of approximately 15 minutes, we will continue our discussion.
There's only one correction that Fateh has pointed out in one of the slides. If you go back to the previous slides, there is an abbreviation which is wrongly mentioned.
Okay, for that. This slide?
Previous one.
Fateh, this one?
No, previous one.
This one?
No, previous one. Yes, this one. So point number 2, if you notice, it's
yes, it's right. So here is a small typing error. Here, fair value through
comprehensive income.
other comprehensive income. Thank you, Fateh. Okay.
That's all I think. Imran is saying, can we take the break 20 minutes?
Okay.
We have to finish the content for today in time, so I think let's stick to 15 minutes. Yes. So it's a 15-minute break. We will resume exactly after 15 minutes. The time by our watch is 35 past 2, which means we will resume at 50 past 2. So, see you then.
and we were discussing financial asset, debt assets, accounting treatment. All other financial assets that are debt instrument must be measured at fair value through profit and loss. Okay. What is the exception to this principle? Even if an instrument meets the above criteria for measurement at amortized cost or fair value through other comprehensive income, IFRS 9 allows such financial assets to be designated at initial recognition as being measured at fair value through profit or loss if a recognition or measurement inconsistency, that is accounting mismatch, would otherwise arise from measuring assets or liabilities or recognizing the gains and losses on them on different bases. See, for example, if an entity holds a financial asset that is debt asset mean, and that carries a fixed rate of interest, but is then hedged with an interest rate swap that swaps the fixed rate for floating rates. The interest rate swap mean, I mentioned here, like example is interest rate swap. Interest rate swap, and there was a fixed debt asset fixed rate. So the interest rate swap is a financial instrument that would be held at, we will learn in the coming session that this will be held at fair value through profit and loss. Okay, and so accordingly this financial asset classified as debt also needs to be at fair value through profit or loss to ensure that gains and losses arising from both instruments, from this instrument, are naturally paired in income and thus reflect the substance of the hedge. If the financial asset classified as debt was accounted for at amortized cost, then this would create the accounting mismatch. Or in other words, this is your financial asset, and this is such financial asset which fulfills business model condition and contractual cash flow conditions. Mean cash flow model and business model both conditions are being satisfied by this financial asset. So as per the principle, we learned that this should be subsequently measured at amortized cost. So if you have entered into an interest rate swap for this fixed rate, from fixed rate to the floating rate, and the interest rate swap is also a financial instrument, and this will be carried at fair value through profit and loss. So this interest rate swap related to this asset, and this asset is being carried at amortized cost. So this will create an accounting mismatch. In such situation, standard allows you to subsequently recognize this debt asset at fair value through profit or loss. Similarly, for those debt assets where the criteria is being met, which is necessary to subsequently measure them at fair value through other comprehensive income, and similar type of accounting mismatch will create. So the standard allows you to subsequently measure such debt asset instead of fair value through other comprehensive income to fair value through profit and loss. So this was the exception. Okay. Next is accounting treatments, initial measurement and subsequent measurement. As we learned, subsequently we can measure a financial asset either at amortized cost, fair value through other comprehensive income, and fair value through profit or loss. Financial assets are initially measured at the transaction price, that is fair value, the consideration given. This is important. Please remember, on initial measurement, fair value, if subsequently it will be measured at fair value through profit and loss. Profit and loss. Fair value plus issue cost. Plus issue cost, if it will be subsequently measured at amortized cost and fair value through other comprehensive income. This means in case of this, on initial measurement, you will add the issue cost to the fair value on initial recognition. And similarly in this case. So let me correct this. It should be fair value through other comprehensive income. It is correctly written over here, but this abbreviation was not correct. It should be fair value through other comprehensive income. And for this, simply fair value. Simply fair value. If you people have any question, we can answer that question. Have we announced the second break today? We shall be having a break at a short break of 10 minutes at 4 o'clock.
1 hour from now.
Approximately 1 hour from now.
There are a few questions.
Yes, please.
So, for example, Kumar is saying, are these conditions only for subsequent measurement? This was from the previous session.
Yes, these are the conditions for subsequent measurement.
RF Javed is saying that you have had too much to eat and therefore your audio is very low after the. I'm sorry.
Who is this saying?
RF Javed is saying that the audio is too low after the break.
Okay, Arif, I did not realize that. You were very right, but the camera is not covering that area. Arif, you are correct.
Shayan is saying, can you explain accounting mismatch in detail again?
Who is this?
Shayan.
Shayan, see, okay. You have invested in the bonds. You have invested in the bonds, 10% bonds, fixed rate. Fixed rate. Okay, let me use a separate page for this. Hopefully I'll find. So this is the beauty of this page, and whenever I come here, it is clean. Okay. Arif, I will try to be as louder as possible, but I suppose I'm not doing it consciously anyway. Okay. So 10% bonds you invested in. 10% bonds. So this is your financial asset, which is a debt asset. Debt asset. Okay? And subsequently, you will be measuring this debt asset at amortized cost. Amortized cost. Subsequently, you will be measuring this debt asset at amortized cost because business model test, and cash flow test are being met. Okay. Now what happened? You enter into an interest rate swap. From fixed to floating. Okay. And this interest rate swap is also a financial instrument. This is also a financial instrument. And this interest rate swap relate to this debt asset. And any gain or loss will be recognized in the profit and loss account. So standard says, because here it is being measured at amortized cost. This means the changes in the market interest rate will not affect the carrying value of this asset. So this is accounting mismatch, because the related financial instrument is the gain or loss this is being measured at fair value, and the resultant gain or loss is being transferred to the profit and loss account. Here no gain or loss, because this is not being remeasured at the fair value. So this is the accounting mismatch. So standard allows you in such situation, even though these criteria are being met, you should treat this financial asset, you should measure this financial asset subsequently at fair value through profit and loss, so that both should end in the profit and loss account. So this was the accounting mismatch, because related instrument was being accounted for on an amortized cost, whereas the related financial instrument was being treated on a fair value basis. So this was the accounting mismatch. Okay, so let's move further. I hope it should be clear. Number 2. Okay, we were on this slide. Again, this subsequent measurement is written before the initial measurement, because initial measurement is dependent on the subsequent measurement. If you have decided for whatever reason that you will be measuring your financial asset, which is debt asset, at amortized cost, so initially you will be measuring that debt asset at fair value plus issue cost. Likewise, if you have decided, because certain conditions are being fulfilled, that your financial asset or debt asset, you will be measuring that debt or financial asset at fair value through other comprehensive income. Again, initially it will be measured at fair value plus issue cost, and when you will be measuring a financial asset at fair value through profit and loss. So initially it will be measured at the same value. Okay. Then is example. We can use this example to understand the concept which we just discussed, and a couple of pop-up. You should be ready for a couple of pop-ups as well. See, an entity ABC Limited purchased a 5-year bond on 1st January 2010 at a cost of 5 million with annual interest rate of 5%, which is also the effective rate payable on 31st December annually. At the reporting date of 31st December 2010, interest has been received as expected, and the market rate of interest is now 6%. Account for the financial asset at 31st December on the basis that it is classified as fair value through profit and loss, as it is classified fair value through profit and loss, and if it is classified to be measured at amortized cost on the assumption that it passes the necessary test and has been properly designated at initial recognition. So before we move to this question, if you have any question related to our last discussion, please ask that. Okay, do we have any question? Not yet. Okay, fine.
We can make the announcement again.
If you have any question related to our discussion so far, you can ask that question before I discuss the solution for this financial asset, which is debt asset. We will be having a couple of pop-up questions as well. Okay. Okay, if it is classified, okay, first of all, number one, what is the fair value for this? The fair value for this is the consideration received. So this is the consideration received because the nominal rate and the effective interest rate is the same. Okay, this is the amount at which this asset will be initially recognized, mean debit, financial asset, which is debt asset, financial asset, 5 million, 5 million, and okay, my pen should work. I think it has also taken 5 million, and credit, cash or bank, 5 million. This is the initial recognition. This is the initial recognition. This will be initially recognized at this amount. Okay. After 1 year, we need a blank page. See, year opening financial asset, opening financial asset, then related to this finance income at the rate of effective interest rate, which is 5%. which is 5%, and then cash received. Cash received, this will be calculated at the nominal interest rate, which is again 5%, and this will be our closing financial, this will be our closing financial asset. So A plus B minus C. So this will be our carrying value at the end. Say this year one is, this asset was issued on 1st January 2010. So year one is 2010. This year one, 2010. Opening amount is 5 million. And interest on this 5 million at the rate of 5% will be 0.25, and the same is the cash received. So this will give us 5 million, but because we are solving number one, so number one is being subsequently measured at fair value. So this means we will calculate fair value because there are changes. In the market interest rate. If you go to the question says at the reporting date of 31st December 2010, interest has been received as expected and the market rate of interest is now 6%. So this means due to this change, fair value of this asset, financial asset, is changed. So we shall be recalculating the fair value of this financial asset on 31st December 2010. And the method will be the same. That what are the future cash flows from this point in time, from this point onward, what are the future cash flows? Of course, future cash flows are annual interest receipts, and at the end capital repayment. So from this point in time, 4 years are remaining. This means 2011. This is first year with reference to this point. 2012, 2013, 2014. Its life is 5 years. Okay, this is the 5th year. So what is the cash flow attached to this? 0.25, 0.25, and at the end of the year 5.25, because we will receive interest plus the capital. Then is the discount factor. Discount factor will be at the rate of 6%. So here first year discount factor will appear, here second year discount factor will appear, here third year discount factor will appear, here fourth year discount factor will appear. So this will give you, on first year, this will give you 0.2358. 2358, and for second year this will give you 2225, and third year this will give you 0.2099, and on fourth year 4.1585. When we add all these figures, this will give us 4.8267. So this is the fair value. This is the fair value of this financial asset as at 31st December 2010. As at 31st December 2010. Whereas its carrying value before any adjustment is 5 million after taking into account during the year effect. So this is 5 million. So when we calculated the fair value of the financial asset due to change in the interest rate, so this is 4.8267. If you just recall, this is the same as we learned in case of financial liability. There we learned how to calculate the fair value of a financial liability. The same way, you just need to write down the cash flows related to that financial liability from the date when you want to measure its fair value. And then you will be discounting those cash flows using the interest rate prevailing on the date you are measuring financial liability fair value. So that discount rate will be applied to those cash flows, and the sum, this will give us the present value of those cash flows, and the sum of all the present value will become the fair value of the financial liability. Similarly, for asset at the end of 2010, when it came to our knowledge that market interest rate has changed, this means the fair value of our financial asset has changed. So how can we calculate that fair value? Simply we see what are the future cash flows related to this financial asset. So because we were at this point in time, and we were at the end of this year, so these were the cash flows from this point related to this financial asset. And we applied the discount factor of 6%. And here, just because I do not have enough space, so I have mentioned here one discount factor for year 1, and we all know that this is 1 divided by 1.06 raised to power 1. And similarly, for year 2, 1 divided by 1.06 raised to power 2, and likewise for third year and for the fourth year. And this gives us the present value for each year, and when we added all the present value, this gives us the present value, this gives us the fair value of the financial asset as at 31st December 2012. Now, this amount will become the closing financial asset, and the difference between these two, 5 million and the 4.8267, which is 4.8267 minus 5. The difference between the carrying amount of financial asset and the fair value of the financial asset is 0.1733. This will be taken to the profit and loss account. Here our asset is decreasing, so the financial asset will be credited. With 0.1733, whereas profit and loss account will be debited with this amount. This entry will take place on this date. So as a result, the carrying amount of our financial asset will become, instead of 5 million, this will become 4.8267. So for 2011, the financial asset is now 4.8267, and for second year, your effective interest rate is now 6% till any further change. So this will give us 4.8267 into 0.6%. This will give us the finance income of 0.2896. Again, you have received the cash at the same rate because this was agreed at the start. So again, when we apply the same formula, 4.8267 minus 0.25, this will give us the closing balance of 4.8663. If you people have any question about these calculations, please feel free to ask before I move further. If you people have any question related to this calculation, please ask now.
Musa Rayami is asking, in case that the effective interest rate is fixed, what will be the fair value of?
Musa, effective interest rate can be fixed, but it depends on the market. With the passage of time, the market rate can move. So as a result, your fair value will be calculated whenever there is a change in the market rate of interest. Every time your market interest rate will be used for the calculation of the fair value, and that will be your effective interest rate. But if original effective interest rate, which was 5% right at the inception of this agreement, if that remains the same, it means market interest rate remains 5% throughout the life of this financial asset, then we can say that effective interest rate remains the same. Then your finance income will of course be calculated at 5%. I hope, Nusa, it is clear.
Muhammad Imran is saying, there's no question related to this question, but if we change from IAS 32 to IFRS 9, how we apply IAS 8 change in accounting policy? Sorry, again. If we change from IAS 32 to IFRS 9, how do we apply IAS 8 change?
We will see it if we will discuss the transition provision. Anyway, please correct your question, because you will be changing from IAS 39 to IFRS 9. So that will be covered under transition provisions if these will be discussed during these sessions. So this question will be covered under those, under that aspect. So right now, because I want to make sure that our respective members are clear what I have written on the screen, so that I could move further.
Okay. How is the 0.2358 calculated?
0.2358. 0.2358. Okay. 0.2358 is calculated by multiplying 0.25, which is the interest received, with the first year discount factor. First year discount factor is 1 divided by 1.06. This gives us 0.4933. into 0.25. So this will give us 0.2358. Next.
Joris are saying, for an instance, we have fixed coupon rate, then cash flow will be the same, but market rate of return is different from what we are actually receiving. That means we should bring the value of asset down. Please clarify.
Yes, you are right. The amount which you will receive will remain the same in case of fixed interest rate, but every time the market interest rate moves, you will have to adjust your financial asset. It could be upward, it could be downward. For example, in this case, because market interest rate is increasing and this financial asset is offering only 5%. So this means from financial management point of view, this bond has become less attractive. So that's why when we calculated the fair value, this fair value is lower than the carrying value of this asset, which is 4.8267, because it has become less attractive because it is offering only 5%, whereas the market has moved to the 6%. You are very right.
Okay. Mohammed Imran, can you please clarify your question? He's just written under transition process. Okay.
Under transition provision.
Okay. Nuzar Rehami is saying, is this calculation exempted for pension fund? I mean, we calculate the interest income of bond based in the accrued interest during interest 365 days.
See, Nusa, see, right at the start we discussed, but if this is clear, I want to move from here. I think there is no question related to this so that I could answer Nusa's question. Nusa, just hold your question, I'll be answering you.
Shayan Ahmed Qureshi is saying, what will be the impact of this calculation on the tax liability of the company?
Who is this gentleman?
Shayan.
Shayan, see, though we will be discussing under the deferred tax, but from tax people, whatever cash you have received, normally they take it as your finance income. They normally they do not have the concept of, tax law does not recognize the concept of the effective interest rate and the way you calculate your financial asset. So this will give rise to temporary difference. This can give rise to the temporary differences, and which can result in deferred tax asset or deferred tax liability, depending on the provisions of the tax law. Any other questions should I? Okay, Nusa, see, if I move from here, we learned here while studying the scope of these standards. This was we discussed in, I suppose we discussed in 1. Yes, in 1. We discussed it in 1. Where we discuss the scope, I suppose. It should be in ISO 32. Here. Here we discuss the scope. I just want to refer to this slide. See, certain items are excluded, and this is not only for 32, it is also for IFRS 9. So pensions and other post-retirement benefits, ISA 19, is not covered under these standards. Nusa, I hope it should be clear. Is it clear, Nusa? Okay.
There's one more question.
Yes.
That's Zaid bin Afaq. Saying, if we carry financial assets at FETPNL, however that security has active market, so in that case we will require to value the same through valuation rates. So what would be the closing value of the financial asset to be included in the balance sheet?
What's the name of this person?
Zaid bin Afaq.
Zaid, see, if it is being actively traded in the market, of course that fair value will be used. But even if you apply the market interest rate, the same value will appear, but that market value will be used instead of making these calculations. Okay. Now, come back to the same question and to the second requirement. See, we started the question under which on 1st January 2010, 5 million, this was our financial asset and its life was 5 years, and initially interest rate and the effective rate were same. If it is classified to be measured at amortized cost on the assumption that it passes the necessity test and has been properly designated at initial recognition. See, initially, there is no issue cost. Had it been there, you would have deducted that issue cost while initially recognizing this financial asset. However, there is no issue cost, so initial measurement will be the same as you did, because we will be recognizing this financial asset at fair value, which is the consideration received, credit, consideration given, cash 5 million. So this will be the initial entry, initial recognition. And second, subsequently, if it is being measured at amortized cost, see, the first year is 2010, second is opening asset, financial asset mean. This is again finance income, at the effective interest rate right at the start. In this case, right at the inception of this agreement, and then cash received or the interest received at the nominal rate, and this will be the closing asset. So this is 5 million, this was 5%, so this was 2.25, this will be 0.25, so closing will be 5. Every year this will be the same. Every year, every year this will be the same. 5, 5, 5, 5, 0.25, because we shall be using the original effective interest rate and this will not change. So every year this will be the closing balance. This will be the closing balance. This will be the closing balance. So this way, we shall be accounting for a financial asset when it will be subsequently measured at amortized cost. I hope this concept is clear. Okay. Okay. Then is the equity asset. We want to have a pop-up question. Okay. Before we move further, I would like you to answer a few pop-up questions. And for that pop-up question, I shall be using these slides. IFRS to IFRS 32 revisited. So first of all, I will read it for you, and then I'll be making a couple of pop-up questions from this compound instrument. Aaron issued 1 million convertible bonds on 1st June. I would request that everyone should participate. in this exercise. Aaron issued 1 million convertible bonds on 1st June 2006. The bonds had a term of 3 years. Term is 3 years and were issued with a total fair value of 100 million, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum, and bonds without the conversion option attracted an interest rate of 9% per annum on 1st June 2006. 1st June 2006 is its date for when you issued these convertibles. 1st June. Okay, the company incurred issue cost of 1 million. Fine, 1 million. If the investor did not convert to shares, they would have been redeemed at par. At maturity, all of the bonds were converted into 25 million ordinary shares of $1 of Aaron. No bonds could be converted before that date. The directors are uncertain how the bonds should have been accounted for up to the date of the conversion on 31st May 2009 and have been told that the impact of the issue cost is to increase the effective interest rate to 9.38%. See, first pop-up question is, because we have sent them the slides, so this should be in front of them.
So take me a couple of minutes to put it up so they can still read it.
Okay, it is in front of you. It is in front of you. You can have 1 minute or 2 minutes by the time you should open on your system as well. This is in the slides titled International Accounting Standard 32 Revisited. So go to those slides.
This is slide number 7.
This is slide number 7. I suppose this is the last slide under that title. So go to that slide and read it carefully, because a couple of pop-ups will be prepared from this write-up.
So what's the first pop-up question?
First pop-up question is, what are the future cash flows? What are the future cash flows? What are the future cash flows? Number one option. Number one option, 6 million interest per annum. And 100 million capital repayment. This is option 1. Option 2. Option 2 is 9 million interest, 9 million per annum. Capital repayment, $100 million. Option number 3. Interest 9 million per annum. Interest 9 million per annum. Capital repayment. Capital repayment 109 million.
answered.
Yes. Yes. Pop-up question is in front of you now, I suppose. You have 1 minute to answer this question.
30 seconds left. It's a very close time. Very close time. All right. About 30% people have voted, so I'm just giving 30 more seconds with your questions.
Yes, yes.
Want more people to answer it?
Yes.
There are a few people who are away. You should come back. Take your choice. My dashboard is telling me there are 49% people who are attentive right now, they're listening. 51% are not. Anyway, so, all right, I'm going to stop here. 35% people responded. The answer I'm going to share on your screens. Answer is 39% people thought this was 6 million and 100 million capital repayment. 42% thought it was 9 million and 100 million capital repayment. 18% thought it was 9 million and 109 million capital repayment.
39% are correct. See, very simple. What are the cash flows attached with this instrument? Every year, this is the cash which will be paid on this nominal amount. So this means 6 million each year. This is the interest payment each year. And then at the end of third year, you will receive 100 million, because it is written here that if it is not converted, it will be redeemed at par. Par means the same amount, the same face value you will receive at the end of the third year. So first, second, third, cash flows will be for first year 6 million, second year 6 million, third year 100 plus 6 means 6 interest, and this is the capital redemption. Okay. So the second pop-up is, please note this because we will continue very quickly with these calculations. 6 million, 6 million and 106 million. This is capital repayment and this is the interest payment in the third year. So these are the cash flows attached to this convertible bond. Second pop-up is these cash flows will be discounted using interest rate of option 1, 9%, option 2, 6%.
2 options.
Yes. Please pop up the question.
Sharing on your screens now. There you go. Cash flows will be discounted using the interest rate of 9% or 6%. Seconds. Five more seconds. Alright, time's up. And the results so far, 9%, so 69% thought it was 9%, 31% thought it was 6%.
69% people are correct. Please, who are 31%, please note that these cash flows will be discounted at effective interest rate, which is the market interest rate, which relates to a loan without any attraction for the conversion. So 9% will be used. So anyway, I came back to this illustration just for a couple of pop-up, but at the same time, some of our respected members asked a question related to what will happen if we, if at the end of the life of this convertible bond, shares are issued. So in order to explain that journal entry. So okay, let's use a blank sheet. See here in this case, when you will discount these cash flows of year 1, 2, 3, cash flows were 6 million, and 100 plus 6, 106 million, and the discount rate is 9%. So this means first year discount factor is 9174, and second, because this is available with me, otherwise I have mentioned here the formula like 1 divided by 1.09 for first year, 1 divided by 1.09 raised to power 2 for second year, and for the third year it is 0.7722. This will give us 5,505.50, and this is 81852 when we multiply these two. This is discount factor, and which is 9%. So total will become 92407. This is debt element. And equity element will be is equal to 100 minus 92.407. Here I note it should be dot. Here it should be dot. Here it should be dot. So this will give us 92.407. The figure is in million, so this will give us 7.593 million. So this is the equity element. So now next we will allocate issue cost. Debt element is equity element equity element, which is 407.407 and 7.593 issue cost. Issue cost, I think we should take a 10 minutes break here so that I could recover from the attack of the cough. Then we will continue. Thank you very much. Sorry for any inconvenience it caused, but it was necessary because I started feeling that I cannot continue without the break. So thank you for your bearance. Okay, issue cost is 1 million. 1 million is the issue cost, and the total of this is 100. This is the total column. Now we shall allocate this 1 million, to the debt element and the equity element. So this 1 million will be allocated on a pro rata basis in their respective ratio. So that's why this will become 0.924 million, and this will give us 0.076 million. So the debt element is 91.483, and this is 7.517. Before I move further, if you people have any question, please ask now. Otherwise, I will be showing you the rest of the calculation and the journal entry which you will pass if this convertible is converted into shares. Do we have any question, please?
Shayan Ahmed Qureshi is saying, what if the whole debenture converted into equity?
Shayan, just hold your question. I'm going to answer that.
Yushan was saying, please specifically tell the total break, start, and time. I think, Zishan, we already started. We took a 10-minute break for prayers and tea. Shayan again had asked what will be the equity value of the debt? What about the 9.38% rate?
Shayan, that will be answered very shortly.
Okay, Sayed Arsalan Gilani had said, but shouldn't it be 106?
Which one?
I'm not sure what he's talking about, but 106. It shouldn't be 106.
106. This one, Arslan, this one. You are talking about this one.
Arslan, please clarify your question. Kashif Rashid is saying, kindly give the example of other FA debt assets that must be measured at FVTPL. So the previous
Fair value through profit and loss.
Profit loss.
Like trade receivables, like if you have any market traded debentures. So these are the two examples.
Imran Samad is saying we need to allocate financial assets into debt and equity portion.
Yes, we learned it under ISA 32. In case of compound instrument, we will have to bifurcate it between debt and equity element. Okay.
So Shayan, your question about the venture conversion to equity, just hold on to that.
Yes.
That's all we have so far.
Okay. So next, what you will do, so remember this is our figure. This is our figure. So if we, let's go to the normal mode so that I need some more space. Okay. So at the end, if shares are issued, your entry will be like credit share capital, because the face value of each share is $1, we shall multiply it with, because we'll be issuing 25 million. If you just look at the question, the question says that on conversion 25 million ordinary shares of $1 of iron will be issued on conversion. So each dollar face value is $1, so this will give us 25 million. 25 million. Okay. Debit will be that equity reserve. Debit will be your equity reserve, which is equity account plus debit will be your financial debt account, financial liability account. Equity account will be debited. So in total, this will be debited with 107,517. Equity will be debited with 7. Sorry, I should mention here dot 7 point, as we have calculated here, 517 107.517 minus 7.517, and then debt, because in the debt account at the end of third year you will see that the carrying amount of the debt is 100. So these two accounts will be debited with the respective amount, and the balancing figure will go to the share premium account, which is 82,517. Shayan, I hope it should be clear. This is the closing entry when you issue the shares. Because over the period of 3 years, debt carrying value will reach 200 million. So you will make it 0, and whatever is lying in the equity, you will make that equity element 0, and the whole amount will be transferred to the share capital, and the balancing amount will be transferred to the share premium account. Shayan, I hope it should be clear. Okay. Another question asks, so which rate will be applied subsequently for the measurement of the finance interest related to this debt element? That will be applied 3.8%, because we shall be recognizing this amount after the effect of the issue cost. So the effective interest rate, which has incorporated in itself, it is given in the question, it has incorporated in itself the effective interest rate that will be used for the preparation of the schedule, which will be used for the determination of the amounts related to the profit and loss account and the statement of financial position figures.
Shreyans has replied saying that he's not clear. Can you please re-elaborate the entry figures?
Entry figures. Okay, I'll have to make a small schedule for you. See, from, okay, let's come here. See, we recognized after issue cost, that was 91483. For clarity purpose, I am removing, I am taking figures in thousands. Okay, equity element was 7517. Now what will happen on first year, on life is 3 years, so in first year, year 1, year 2, year 3. Opening will be 91483. Okay, so interest cost at effective interest rate, this will be at the rate of 9.37. It is given in the question. So this will give us 8581, and interest paid is, or cash paid is, at the nominal rate, which is 6% on the face value, and that is 6,000. So the closing will become 94064. 94064, and in the second year this will become 8823 when you apply 9.37% on this, and this will remain same. So your liability will become 96887, and in third year 96887 9088, and again 6,000. So this will give you 100,000. So here you have already credited the equity with this amount. In equity, in the other component of equity, you already have 7517. Till the end of third year, it is there. Now at the end of third year, your debt element have 100,000. So you just need to make these two things zero. Why? Because this convertible is being converted. So when you want to make equity zero, of course, you will be debiting this equity reserve account with the amount within that account. And similarly, when you want to make the debt account zero, simply the amount lying within that account will be debited. And what you did with these figures, you settled them by the issuance of share capital. You can see that within the question it is mentioned you will be issuing 25 million shares. So share capital will be credited with the 25 million into the face value. So this will be credited with the 25 million. The remaining amount, because the remaining amount will go to the share premium account, which is 8282517. Shayan, I hope it should be clear. No, all the calculation is in front of you.
In the meanwhile, Imran Samad, Shayan says yes. Imran Samad says these illustrations are mainly related to the issuer's perspective.
Yes.
Can you please show us entries from the holder or investor's perspective?
So these entries are from the issuer of convertible bond perspective. These entries are with reference to the issuer of the convertible aspect. So, okay, let's go back. Actually, we came here to this illustration just to just for a couple of pop-up, and then I think Mr. Shayan asked a question related to this entry. So I remembered that this entry can be explained with the help of this illustration. So we go back to our previous discussion. Okay. We were discussing about financial asset. We were discussing about yes. We were discussing about financial asset. We completed this question. And if I just remind you what we discussed in fact that this is the summary. We discussed in fact the financial asset which is equity asset. So we are discussing if you are the holder of this financial asset. Subsequent, of course, if you are holder of this financial asset, this the issuer will be, for issuer this will be a financial liability. So so this is with reference to the holder of the financial asset. We learned fair value through profit and loss account. This is the default position and mandatory for held for trading, and fair value through other comprehensive income if the entity elect at inception. Sorry, this is, now we have started discussion of the equity asset. I suppose perhaps this is the summary of the debt asset. Sorry, financial asset which are equity asset. So we have two options for subsequent measurement. One is fair value through profit and loss. If it is held for trading, so this is the only option. If it is held for trading, if equity asset is held for trading, equity asset means you have bought the shares of another company. You have, so this is your investment, this is your financial asset. This financial asset can be termed as equity asset. So if it is held for trading, you do not have any other option. You will have to account for this equity asset fair value through profit and loss. But if the entity elect at inception, then an entity can measure this equity asset subsequently at fair value through other comprehensive income. Okay, these are the subsequent measurement. Initial measurement. Fair value, if subsequently it will be measured at fair value through profit and loss. Fair value plus issue cost, if it will be subsequently measured at fair value through other comprehensive income. Okay. Okay, this was the treatment which we wanted to discuss related to the financial assets. Financial assets were categorized into debt assets and equity asset. We learned how to measure initially and subsequently the debt asset, and we learned how to measure the equity asset. Now let's move to some qualitative discussion. We learned that business model test, collecting the contractual cash flows. What does it mean? It means business model test when you assessing the business model test, it should not be assessed at an individual financial instrument level. IFRS introduces a business model test that requires an entity to assess whether its business objective for a debt instrument is to collect the contractual cash flows of the instrument as opposed to realizing its fair value change from sale prior to contractual maturity. Note, the assessment is based on how management personnel actually manage the asset, how they manage the asset, rather than the management intentions for specific financial assets. See, an entity may have more than one business model for managing its financial asset, and the classification need not to be determined at the reporting entity level. For example, it may have one portfolio of investment that it manages with the objective of collecting contractual cash flows, and another portfolio of investments held with the objective of trading to realize changes in fair value. It would be appropriate for entities like these to carry out the assessment for classification purpose at portfolio level rather than at entity level. So when you apply a business model test, you need to take care of these two things, that it should not be on an individual financial instrument level, and it should be the way management manages its portfolio. If different portfolios are being managed differently, then you should apply this business model test portfolio wise instead of entity wise. See, although the objective of an entity business model may have to be to hold that financial asset in order to collect contractual cash flows, the entity need not hold all of those assets until maturity. Thus, an entity's business model can be to hold financial asset to collect contractual cash flows even when sales of financial asset occur. We can look at this concept with the help of an example. Example is with us. Okay, this is the example. Okay, let me reduce its. Hopefully you people can see it. A company holds investment to collect their contractual cash flows, but would sell an investment in a particular circumstances, perhaps to fund capital expenditure or because the credit rating of the instrument falls below that required by a company's investment policy. This is their practice, that they hold investment to collect their contractual cash flows, but at occasions, in a particular circumstances, that it happens that they may sell any of those instrument in order to fund capital expenditure or for some other purpose. This could be the possibility. See, a company's objective is to hold the financial asset and collect the contractual cash flow. Some sales would not contradict that object. If sales became frequent, a company might be required to reconsider whether the sales were consistent with an objective of collecting contractual cash flows. So if sales are not frequent, then a company means they are holding their investment to collect their contractual cash flow. This means a company will have to measure their debt asset subsequently at amortized cost. Do we have any question? If we have any question, please ask them. Not yet. Okay. So second is, we go back to our slide. Contractual cash flows. Contractual cash flows only constitute principal and or interest cash flows. See, like where interest could be entirely fixed, floating, a combination of fixed and floating. There are a couple of examples which will where you will find that an instrument is fulfilling this criteria. Contractual cash flows attached to that instrument fulfilling this criteria, like a variable rate instrument with a stated maturity date that permits the borrower to choose to pay 3 months LIBOR for a 3 months term. This is one example. Another example is a fixed term variable market interest rate bond where the variable interest rate is capped. Third example is a fixed term bond where the payments of principal and interest are linked to an unleveraged inflation index of the currency in which the instrument is issued. Please remember, the following or the instruments, some of the instruments which apparently seems as debt asset, they are not in fact, they do not fulfill the criteria of contractual cash flows. And one example is convertible bonds. Convertible bonds do not fill the criteria of contractual cash flows because of the inclusion of the conversion option, which is not deemed to represent payments of principal and interest. So that's why convertible bond, so that will not satisfy the criteria of contractual cash flows. Business model test, collecting the contractual cash flows and selling the financial asset. Okay, let's understand with the help of example number 4 and 5. Example number 4. D company expects to incur capital expenditure in a few years' time. Okay, D company, so it should be in front of me as well. D company invests its excess cash in short and long-term financial asset so that it can fund the expenditure when the need arises. Many of the financial assets have contractual lives that exceed D company's anticipated investment period. D company will hold financial assets to collect the contractual cash flows, and when an opportunity arises, it will sell financial assets to reinvest the cash in financial asset with a higher return. The remuneration of the managers responsible for the portfolio is on the overall return generated by the portfolio. This is an example of this situation. This is a business model test where the collection of the contractual cash flow and selling the financial assets, both objectives are involved. See here in example number 4, the objective of the business model is achieved by both collecting contractual cash flows and selling financial assets. D company decides on an ongoing basis whether collecting contractual cash flows or selling financial asset will maximize the return on the portfolio until the need arises for the invested cash. So this was the example. There is another example. I will read it for you. F bank holds assets to meet its everyday liquidity assets needs. The bank activity manages the return on the portfolio in order to minimize the cost of managing those liquidity needs. That return consists of collecting contractual payments as well as gains and losses from the sale of financial assets. To this end, F Bank holds financial assets to collect contractual cash flows and sells financial assets to reinvest in higher yielding financial assets or to better match the duration of its liabilities. In the past, this strategy has resulted in frequent sales activity, and such sales have been significant in value. This activity is expected to continue in the future. So what is the analysis? See, the objective of the business model is to maximize the return on the portfolio to meet everyday liquidity needs. And the F Bank achieves that objective by both collecting contractual cash flows and selling financial assets. In other words, both collecting contractual cash flows and selling financial assets are the integral to achieving the business model's objective. So in such situations, we learned that such instruments must be subsequently measured at fair value through other comprehensive income. Okay. Now, let's come back to our slides. So now, let's discuss about the reclassification. We need to note certain things. Reclassification means maybe from fair value to profit, fair value through profit and loss account to fair value through other comprehensive income or to the amortized cost or the otherwise. Reclassification where not permitted. Number one, change as a result of change in the management intention. Change in management intention. So if there is a change in the management intention, this will not affect the classification. You cannot reclassify a financial asset based on the change in the management intention. In fact, their business model should actually change. This change should reflect from their change in the practice, change in their business model. Number two, a temporary disappearance of particular market for that financial asset. So you should not reclassify in such situation. And a transfer of financial asset between parts of the entity with the different business models. So you should not reclassify. In these three situations, reclassification is not permitted. Further, reclassification, please note these are the small points and you can note it. Reclassification of financial liabilities. Reclassifications of financial liabilities are not permitted. Reclassification of financial liabilities are not permitted. And further, reclassification of equity asset. Equity asset, which is financial asset, because we know that financial asset could be debt asset or equity asset. We are talking about equity asset. Reclassification of equity asset is also not permitted. If we have any question, please. Okay. If we have any question, please feel free to ask.
Say the standard is saying, please explain the example one again. So,
okay, example one. See, in example one, now all my writer.
that will do the recording then. It will be in the recording.
Okay.
Musa Rayami.
Yeah, no problem. It is here. Example one is here.
Okay.
Who is this gentleman? Who is this gentleman? Please.
Sayyid Salam.
Sayyid Salam. See, this is example one. Example one says that yes, it should be in front of me as well. A company holds investment to collect their contractual cash flows, but would sell an investment in a particular circumstances, perhaps to fund capital expenditure or because the credit rating of the instrument falls below that required by a company's investment policy. See, here a company objective is to hold the investment, hold the financial asset, and collect the, this is their objective. Some sales, it is not mentioned in the example one. I am using this word that if some means some sale would not contradict that objective. Like if you are holding a number of financial assets and your objective is to hold them to collect their contractual cash flows, but sometime some sales happened during the year for a reason, maybe for capital expenditure or for any other reason. So this would not contradict that objective. This means they will, from the standard point of view, their business model is intact. But if sales become frequent, a company might be required to reconsider whether the sales were consistent with an objective of collecting contractual cash flows, or in other words, if sales are consistent, then the objective of collecting contractual cash flows is not being met. So this means such financial asset cannot be subsequently measured at amortized cost. I hope it should be clear. Okay, Nusa. Yes, what is the question?
Okay. That's it.
You mentioned
the question was, can you send the example of cash model? It's not in the document.
The cash?
The cash model. The example cash model.
Okay, we shall be sending you the examples. Okay, let's come back to our discussion. We were here. Questions? We have any questions?
No more questions.
Okay.
Can I have my questions? My
okay,
questions.
Go ahead, please go ahead.
Fateh Mohammed, the way I asked the question, says, would you please elaborate further the results of wrong reclassification?
The results of wrong classification. This is a very comprehensive question. I don't know, before asking you, have you appreciated this or not? But anyway, I'll try to answer this with the help of a couple of examples. For example, if A financial liability should have been measured at amortized cost, or should have been measured at fair value, but in fact you have measured at amortized cost. What will happen? Under amortized cost, the finance cost which will be charged to the profit and loss account will be based on the effective interest rate at the date of inception of that contract, and that will not change over the life of that asset, of that liability. But if it should have been measured at fair value, then you know that whenever there is a change in the market interest rate, this will affect not only the figure debited or credited, credited to the debited to the profit and loss account, but this will also affect the figure which will be recognized in the statement of financial position. Mean, if you wrongly classify an asset, this will affect the amount to be recognized in profit and loss account and the balances to be shown in the statement of financial position. Similarly, if your business practice is changed and that requires you to reclassify your debt asset, and you do not do that, likewise it will affect your profit and loss account and balances appearing in the statement of financial position. So I hope it should be clear, but your question was very comprehensive. It could be answered from many aspects. Thank you.
Wait, my turn. So before we move towards the concluding 15 minutes, let me ask you my usual poll questions. The first one is about the feedback for today's session. I want everyone on the session to respond to this. So you will see the poll question on your screen. What's your feedback for today's session? Excellent, very useful, good, below average, unacceptable. Please quickly mark your choice. Give you 1 second for it, half a minute left.
I think you should ask another question as well at this point. About the location.
Yeah. There are 15 seconds left. Can you quickly mark your choice? How was your session? What is the feedback about today's session? The answers, solutions.
Yes. Yeah, no, it's not answer. Because we have a couple of minutes, so I'll be giving them some more material.
Alright, I guess that's it. Closing this and sharing the results on the screen. Of course, 32% said excellent, 57% said very useful, 11% said this was good, nobody below average, nobody unacceptable. I think that's very good feedback. Thank you very much.
Thank you very much for your appreciation.
And my last question before we resume is, where are you currently residing? So we want to know where are you getting the session from. So the questions on your screen. If you're from Pakistan, Middle East, Sri Lanka, Bangladesh, or other countries. No.
Can you please approve that part too, which I gave you? No. I have given this. Yes, I have given you.
On that one?
No, on the flash.
If you want to upload it, share it with them right now.
No, not share. Okay,
Email it?
It should be shared so that I could discuss that as well.
Right now?
Yes. I thought perhaps you can do it from here. No, I just
want
want
to share my screen.
Okay.
Continue as well.
So when I open this, okay, it is shared.
When you open it up, you have to share it. All right, thank you very much. This is also done. Sharing the results. So today 57% were from Pakistan, 39% from Middle East, 1% from Sri Lanka, and 3% from other countries.
Okay, other country, I think include one European country. I think.
It was somebody from Melbourne, Sydney, Australia.
Australians. Okay. So I think we have almost covered the whole world. Anybody from Europe? Okay.
Right, there are a couple of questions if you can.
Yes, please.
Questions. Behind the. This. Okay. Shayan Qureshi is saying, what will be the entries for correcting wrong classification of financial assets that has been discussed?
Who is this?
Shayan.
Shayan, see, it depends upon the incorrectness. So, of course, if you can specifically mention, okay, this will be the incorrection, we can discuss its correcting entries. But because incorrection can be of many types, so this will be difficult to say in one line what will be the correcting entries. Because say, generally speaking, if you are measuring a financial instrument using amortized cost, but it should have been measured using fair value. So first of all, you will be calculating the fair value of that instrument at the end of that period. So the correcting entry will be the difference between the amortized cost at that particular year end and the fair value, that will be treated as per the guidance of this standard that will go to the profit and loss account. So if error relate to the previous period, so in accordance with the ISA, but it depends on the type of the error.
Okay. Vikas Safdar is saying very good session today as well. Thank you very much.
Thank you very much. Thank you, Vikas.
Arsalan Gilani saying we'll be having session on consolidation. So we will decide and let you know the date and time for it.
Yes.
We have decided that we will go ahead with that session. Muhammad Salman Yusuf is asking a slightly longer question saying, if an entity classifies an asset as FVOCI, then on change of business FVOCI.
Hold on, just let me do it. If an entity classifies an asset
FVOCI,
fair value through other comprehensive, I suppose, other comprehensive income. FVTOCI. Okay.
Then on change of business model, it appears that it is frequently trading in that financial asset. Is reclassification going to be done, or will it be dealt with as change in accounting policy?
See, number one, if your question, I want to correct your question. See, who is this gentleman?
This is Muhammad Salman.
Muhammad Salman, see, under this we learned that business model and the objective of the business model is both holding to collect the contractual cash flow and selling that asset as well. So if they are selling, so this will not change their model. So please rephrase your question.
Okay, Mohammed Numan is saying thank you very much ACCA. Thank you very much Numan. Thank you for participating. Adil Haq is saying in what circumstances can we reclassify the financial asset or financial liability?
You can see, financial liability cannot be reclassified. It is not permitted. and financial asset, which is equity asset, is also cannot be reclassified. Only the financial asset left with us is the debt asset. That can be reclassified if there is a change in the business model. Like your previous business model was to hold those financial assets which are debt assets to receive their contractual cash flows. But now you have changed your practice, and as a result, frequent sales start. So then your business model will change, and you will have to transfer it to the fair value through profit and loss account.
Right. Bilal Mustafa is saying he's attending this session from Australia. Okay. Muhammad Imran is saying other countries may include people from India also.
But India is not mentioned here, I think.
And somebody from other countries could have mentioned.
Okay.
But Osama Ali is saying that thank you very much, great session. He's attending this session from Sudan.
Sudan, okay. So Sudan is in Africa or in Middle East? Africa. This means Africa, Australia, and Asia. Of course, we are sitting in Asia.
I was saying the entire Asia Pacific is also. Thank you very much. Shayan was saying Shayan Ahmed is Qureshi, who's been hyperactive today. Yesterday was Miriam, today it's Shayan. Heroes of the session. HTM to FVTPL.
H
is tainting concept abolished. HTM to FVTPL.
HTM to FVTPL.
TPL. Through profit and loss.
HTM, please, can you please elaborate this?
Rehan Hussain is saying good session, God bless you, thank you very much.
Thank you very much, Rehan. Thank you very much.
Shayan is saying thank you for your patience, for bearing with so many questions, it was great, thank you very much. Zishan Hafiz is saying next two sessions also cover financial instruments. I think the next one covers financial instruments.
Yes, let me, I have a couple of minutes, so let me tell you about the next session. In the next session, which will be held on coming Friday at 3 p.m., we shall be covering impairment of the financial instruments, and there is a big change in the impairment methodology. Plus, we shall be covering hedging, and the third one, on the request of one of our respected member, IFRS 13. So again, that session is very important, and especially that will, a significant part will be related to the financial instrument. And on Saturday, we shall be covering International Accounting Standard 12.
And that will be our last session, and after that, probably have consolidation. Zishan, you are right. We did mention 3 sessions on financial instruments.
Yes.
So today was the second session. Yesterday was the first. The next session on the next Friday is going to be the third session.
And in third session, we will include IFRS 13 as well at the end, because that IFRS is affecting so many standards. Wherever except few means IFRS 2. And wherever fair value word is appearing, how to measure fair value, that will be answered by IFRS 13. So this is the end, because I was thinking perhaps I can talk on the new topic, but keeping in view the time available with us. So because if we have, yes, we can take the question.
Shayan Ahmed Qureshi is saying the change of classification shall be prospective or retrospective or held to maturity.
Change the prospective.
Prospective or retrospective. retrospective.
Okay.
So prospective.
Yes.
Numan Mirakat is saying thank you once again. Thank you, Numan. Zishan Hafiz is saying can't see green on green. So don't worry. He'll be the notes for Mr. Abu Bakr.
It's not for
Kashif Rashid is saying thanks ACC team and Mr. Abu Bakr. Thank you very much, Kashif.
Thank you very much.
Forecast after very good session. Muhammad Salman, Muhammad Yusuf. I'm not sure whether in one individual, but Muhammad Salman, Muhammad Yusuf could be one name as well. Thank you very much, Mr. Abu Bakr, for your time and patiently answering the questions, and to ACCA for arranging this webinar. Thank you very much.
Thank you.
And you're very right, Mr. Abu Bakr has been very, very patient. He's been eating his sweet all along to keep the sweet pass. Zaman Abdul Ghaffar is saying, thank you, Team ACC and Mr. Abu Bakr, for an excellent session. Thank you very much. Zishan saying nice. Amna Arslan saying Jazakallah khair. Once again, this was very useful in clarifying my concepts. You are amazingly patient in answering questions. Thank you very much.
Thank you.
Zishan Hafiz is saying thank you. Shayan Ahmed is saying what if the whole debenture converted in equity? Is the same question.
Same question. You can see the recording. I have given the journal entries for this conversion.
Kester Majid is saying change to with the funds that we done. I don't know why these questions start again. And I think that's our budget. We still have a couple of minutes. Do you want to conclude, or you want to open the new topic up for about 5 minutes, or do you think it will not be covered? We can otherwise
no, we
the
can.
Next session.
We cannot.
Okay.
We cannot.
Okay. So your new topic will be.
Our new topic will be, as I said, impairment of the financial instrument, and there is a change in the methodology of impairment of financial instrument as compared to IFRS 39. So we shall be discussing with the help of illustrations that what is the new approach, and I will be discussing the old approach as well, so that you could properly appreciate the new approach, and then we shall be discussing the hedging and then IFRS 30. So that's all from our side, and thank you again for your appreciation.
Just a couple of announcements.
Yes, over to Mr. Harun from my side. Thank you very much, and Allah Hafiz.
So you're still here. All right. There are two announcements to be made. The certificates for yesterday's session have already been sent out. So if you check those who were present in the session yesterday, they should find their certificates in their inboxes. Secondly, the video recording for yesterday's session has been uploaded on Vimeo. You should be able to see that in a few minutes. So these were the important announcements. The certificate for today's session will be emailed on Monday, hopefully. The handouts for today's session have already been emailed. And do we want to send out any solutions? We've not been keeping the record. So the solutions discussed today in this session will also be emailed hopefully by Monday to all of you. And that is exactly when we will upload the recording of this session as well, if not sooner than that. So that's all from our side. Thank you so very much for participating. It's been really a rewarding weekend for us, and see you all on the next Friday. Take care of yourselves and have a nice weekend. Thank you.